Startup founders should learn basic finance knowledge and concepts. Today I'm going to explain the profit. Profit means the difference between revenue and expenses. Revenue is anything the company collects from the customer against the product the company sells to the customer or the services the company provides to the customers. But expenses is anything the company pay to get a benefit from. Let's take an example. Assume that you have an office and you are getting the benefit of the office during January, for example, and you are paying the rent of this office. So the rent itself is called expense. I am paying this rent to get a benefit from something, which is the office that I have. One more example. So assume that you pay salaries to the employees. Against what? Against the benefit that you are getting from the employees. So salaries itself is an operating expenses. Some people are asking about the development cost of their website. Assume that you spend $50,000 to develop your website. Is it an expense? The answer is no, it is not an expense. Let's understand why. Because the website that you developed is the platform that the customers is going to register and place their orders. So you are going to enjoy revenue of this website. And this website is going to benefit the company for more than a year. So it might be extended to 2-3 years. So it will not be expense, the value that you spend on it. It will be an asset. So you are going to consider the $50,000 as an asset. In the current year, you started to enjoy some revenues from this website and you already got a benefit from this website. You need to consider an expense related to the benefit that you received from the website during the current year. What you are going to do is to allocate the $50,000 over the useful life of the website. Assume the website is 5 years. The useful life is 5 years. So you are going to divide $50,000 divided by 5 years. The result will be $10,000. This $10,000 is called amortization expense. This is the allocation of the $50,000 over the useful life of the website. And this is the part related to the current year. This is called amortization expense. Actually, this amortization expense, it is not a cash expense. You are not paying it to anyone because you already paid the $50,000 when you started to develop the website. So this expense is not a cash expense. So now you have two types of expenses. You have cash expenses and you have a non-cash expenses. Cash expenses like the rent, salaries, insurance, utilities, and blah blah blah. Non-cash expenses like the amortization, for example, of the website. Now, if you deducted all of these expenses, cash and non-cash expenses, from the revenue, you reach to the operating profit of the company. Now, there are still some other expenses that you didn't deduct. The first one is the finance cost of your loan. Is called interest expense. And the second one is the tax that you are paying to your country. If you deducted the interest and tax from your operating profit, then the result will be the net profit of the company. Let's review again what we explained briefly. We calculated the revenue of the company and we calculated the expenses of the company. These expenses can be cash and can be a non-cash expenses. Expenses that are cash like the payroll, salaries, the rent, the utilities, the insurance expenses, and the non-cash expenses like the amortization, for example. If you deducted both of them from the revenue, you will reach to the operating profit of the company. Then, if you deducted the interest and tax, you reach to the net profit of the company after deducting every expense. Now, let's take another type of expenses. It's called depreciation expense. It is exactly like the amortization. Let's explain it. Assume that you purchased a car. The car that you purchased, you paid today $200,000 in order to acquire and purchase this car. The car that you purchased will not only benefit the company in this year, but will benefit the company over 6-7 years, for example. So you are going to allocate the value of the car, which is 200, over the useful life of the car itself, which is 7 years, for example. So dividing 200 by 7 years equal the amount that's related to the current year. This is called depreciation expense. This is against the benefit that the car is giving you during the current year, and this is called depreciation expense. Investors are asking for a financial plan. Part of the financial plan is a statement to show the profit or loss for the company. Normally, you should prepare this statement for 5 years. So if you are starting your business in 2020, you need to present your financial plan for 5 years, for example, to see the profit each year. So you are going to build your revenue and expenses for 5 years and to show the profit for each year. I hope this helps you to understand basic knowledge about how profit is calculated. Thank you.